Welcome to the Deep Dive Podcast. Supply and Demand Pro.
Welcome back to the Deep Dive. We're the show that takes, piles of complex analysis and really breaks it down into something useful, something actionable for you. And today, we're diving into what might be the biggest hurdle for any active trader. That moment of hesitation.
Oh, absolutely. Everyone feels that. You've done the homework, marked your levels on the chart, and then price gets there to that critical spot.
Yeah, you're lying in the fan.
Right, and you just freeze up. Is this real buying coming in? Or is it, a fake out? A trap set to grab stop losses before the market really moves? That moment of doubt, that pause, it costs you. In money, in missed opportunities, and definitely in confidence.
That's exactly the problem we want to tackle today.
Yeah.
We're going deep on a pretty sophisticated tool called the Supply and Demand Pro Indicator. Think of it as, an analytical co-pilot for your trading. It's designed specifically to swap out that subjective hesitation, that gut feeling, with objective, data-driven analysis. It takes a whole bunch of market factors and boils them down into one really clear signal.
But before we get into the indicator itself, we really need to lay the groundwork. Because supply and demand trading, fundamentally, it's different from your standard support and resistance thinking.
Right. How so?
Well, support and resistance lines, they're historical, they're reactive.
Yeah.
They just show you where price happened to turn around in the past. They tell you what happened.
Okay, just points on a chart where things reversed before.
Exactly. But supply and demand zones, they aim to tell you why price turned there. And crucially, they're designed to be predictive, leading indicators.
Not lagging. Okay.
Yeah, these aren't just lines, they're price areas. And they represent the leftover footprint, essentially, of big institutional players. We're talking major banks, hedge funds, those sorts of players.
The ones moving serious volume.
Huge volume. So large, in fact, that they can't just jump in or out at a single price point. If they did, they'd move the market against themselves too much. So they have to work their orders across a price range, an area.
Wow. Okay, so they leave unfilled orders behind within that zone.
Precisely. A residue of pending orders. And the theory is, when price comes back to that specific area, those leftover orders get triggered. That creates a reaction, often a predictable one, that you can potentially trade.
Got it. So it's about finding where the big money left its mark.
That's the core idea. And this indicator we're discussing, Supply and Demand Pro, it automates the really tricky parts. Finding those zones, judging their quality, figuring out the timing, and it distills all that complexity down into one key metric.
Which is?
The probabilistic reversal score. It's a single percentage figure.
Okay. And what does that percentage tell you?
It directly answers that critical question. Based on everything the indicator is seeing right now, structure, momentum, price action, order flow, what's the actual calculated probability of a significant reversal happening right here in this zone?
Wow, okay. So it's quantifying the likelihood.
Exactly. Replacing guesswork with a probability score. So our mission today is to walk you through this piece by piece. We'll break down the four analytical engines inside the indicator that generate that score.
The pillars you mentioned.
Right, the 4 pillars. Then we'll show you how to tweak the settings so it fits your trading style. And finally, we'll lay out some concrete strategies, how a newer trader might use it versus how a more experienced pro might leverage it. A full game plan.
All right. Sounds good. Let's unpack this thing. Okay. So to really get why that final number, that probabilistic reversal score is so powerful, we need to understand what goes into it. You said 4 distinct analytical pillars.
That's right. 4 pillars, and they're designed to be non-correlated, meaning they look at the market from different angles. They don't just echo each other.
Okay. What's pillar number 1?
Pillar 1 is the foundation, zone detection and context. The indicator's first job is, finding and drawing these supply and demand zones on your chart automatically.
Right. Identifying those potential institutional footprints.
Exactly. But here's the crucial bit for professional trading. It does this on 2 levels simultaneously. It finds zones on your current time frame, say the 15-minute chart you're actively watching. And it finds zones on a higher time frame that you choose, maybe the 4-hour chart, for example.
Okay. So you see both the immediate picture and the bigger structural picture at the same time. Why is that so important?
It's absolutely critical. Honestly, trading just based on a low time frame, like the 15-minute, without knowing the higher time frame context, it's like trying to navigate a tiny boat in a huge ocean storm. You have no idea what's coming.
Makes sense. You could be sailing right into a giant wave you didn't see.
Precisely. The indicator shows you if that small 15-minute zone you're eyeing is actually sitting right inside or maybe just below a massive 4-hour daily zone, that higher time frame structure. It dictates the overall bias, the risk, everything, really. It tells you if you're swimming with the current or against it.
Got it. Context is king. So pillar 1, zone detection on multiple time frames. What's pillar 2?
Pillar 2 dives into what's happening right now, the immediate price action. It's called price action analysis. The indicator is constantly scanning the chart for specific, high-impact reversal signals, patterns that suggest the big players are making aggressive moves.
Like what kind of patterns?
2 main ones it focuses on are liquidity sweeps. You might know them as stop hunts.
Right, where price spikes just beyond a higher low to grab orders.
Exactly that. Deliberate moves to trigger stops and gather liquidity. The other is powerful engulfing candles, especially when they form inside or right after price interacts with one of those key zones.
And spotting these on the higher time frame is particularly significant, I imagine.
Hugely significant. If you see a big liquidity sweep on the 4-hour chart, like a long wick poking way below a previous low and then snapping back, that's not just random noise. That often signals that smart money deliberately pushed price down, scooped up sell orders, and is now ready to reverse hard.
So the indicator sees that and flags it as important.
Yes, it captures that signal and gives it a good amount of weight in the final score calculation because it reveals intent. It's not just price drifting, it's a forceful action.
Okay, that makes sense. Pillar 1, zones and context. Pillar 2, price action signals. What's pillar 3?
Pillar 3 is about market consensus, momentum alignment across different perspectives. We call it multi-time frame confluence because, let's face it, trying to fight the dominant momentum across multiple time frames is usually a losing battle.
Yeah, swimming upstream is tough.
Right. So to help with that, the indicator has this built-in dashboard. It tracks 2 common momentum oscillators, the relative strength index, RSI, and the stochastic oscillator.
Okay, standard tools.
Standard tools, yes, but here's the key. It tracks them across 6 different time frames simultaneously, all the way from the 5-minute chart up to the daily chart.
6 time frames. Wow. Okay, so you get a really broad view of momentum.
That's the idea. It gives you that instant snapshot. You need the short-term view, like the 5-minute or 15-minute, for precise entry timing. You need the sort of medium-term view, maybe the 1-hour and 4-hour, to see the tactical trend. And you need the long-term view, the daily, maybe even weekly, to make sure you're not stepping in front of a freight train, the major trend.
So if your 15-minute zone looks perfect, but the daily RSI is screaming overbought, the indicator flags that conflict.
Exactly. It recognizes that danger. If the higher time frames are showing weakness for a potential long trade, even if the 15-minute looks good, the indicator will actually penalize the final probability score. It's trying to prevent you from taking trades that are out of sync with the broader market flow.
Okay, very useful. That's pillar 3, multi-time frame momentum alignment. What about the 4th pillar? You called it the secret weapon.
Ah, yes. Pillar number 4, volume. This is where we look under the hood of price movement. It goes beyond standard volume bars and analyzes tick-level data.
Tick data, so like every single trade.
Essentially, yes. It uses a very, very low time frame, think like 1-second data, to measure the aggression of buyers versus sellers in real time. It's looking at the order flow.
Okay, how does that differ from just looking at a standard volume bar?
Standard volume just tells you the total amount traded. Volume delta looks at the difference between buying volume hitting the ask price, aggressive buyers, and selling volume hitting the bid price, aggressive sellers. It shows you who is being more forceful right now.
Interesting. And you mentioned a concept called absorption earlier. How does volume delta help see that?
Right, absorption is key here. Imagine prices dropping sharply down towards a demand zone. On a normal chart, you might just see long red candles. But the volume delta analysis might simultaneously show that even though sellers are hitting the bid aggressively, their selling pressure is being completely soaked up, absorbed by huge passive buy orders resting in that zone.
Like a giant sponge, as you said.
Exactly. You see lots of selling activity, but price just stops going down. It hits a wall. On your standard 15-minute chart, maybe you just see a candle with a long lower wick, suggesting sellers got tired. But the volume delta confirms why they got tired because a massive buyer, likely institutional, stepped in and absorbed all that selling pressure.
Wow. Okay, so it's seeing the hidden battle at the tick level.
Precisely. And If the indicator spots this heavy selling being absorbed by heavy buying right at a key demand level, that's incredibly strong evidence of institutional support. It's not just price slowing down, it's an active defense of the level.
And that's powerful because it's not directly tied to the historical zone placement or the price patterns, right? It's a separate confirmation.
Exactly. It's non-correlated. It's looking at the raw order flow. So adding this volume delta analysis, pillar 4, alongside the zone context, pillar 1, the price action signals, pillar 2, and the multi-time frame momentum, pillar 3. That's what makes the final score so robust.
Right. It pulls all 4 distinct views together. Historical structure, immediate price action, broader momentum, and the hidden order flow.
And synthesizes them into that single actionable percentage, the probabilistic reversal score. It aims to cut through the noise and just give you a clear measure of confidence. Okay, so now that we've unpacked the 4 pillars, the engine behind the score, we can talk about configuring it. Because honestly, the real power comes when you tailor it to your specific needs.
Right, it's not a one-size-fits-all kind of thing.
Definitely not. You need to align it with your trading style, the time frames you focus on, your risk tolerance, all of that.
So where do we start with the settings?
Let's start with the basics, the general toggles. These are just simple on-off switches. You can toggle the visibility of the current time frame zones, the higher time frame zones, the label showing the probability score itself, and that whole multi-time frame momentum table we talked about.
Ah, okay, so you can clean up your chart if you only want to focus on certain elements.
Exactly. Maybe you're a swing trader and you only really care about the 4-hour zones. You could just turn off the current time frame zones to reduce clutter. Quick and easy customization.
Makes sense. What's next? The more critical stuff.
Yeah, now we get into the supply and demand zone configuration. This is really the core engine room. It dictates how the indicator actually finds and defines the zones.
Okay.
And the first, arguably most important setting here is the higher time frame selection. This is where you tell the indicator which time frame to use for that crucial structural context we discussed.
So if I'm trading on, say, a 30-minute chart,
then you must select a significantly higher time frame here, maybe the 2-hour, the 4-hour, or even the daily. There's a common rule of thumb, a guideline really, that suggests using a multiplier of about 4 to 6 times your execution time frame.
4 to 6 times. Why that specific range?
It's about ensuring a meaningful difference in scale. If you're on a 15-minute chart, a 4x multiplier gives you the 60-minute chart for your higher time frame context. A 6x multiplier gives you the 90-minute, or maybe you'd round up to the 2-hour or even 4-hour.
Okay.
The point is you need that separation. If you picked, say, only a 2x multiplier, like using the 30-minute as HTF for a 15-minute chart, the zones on both time frames would be too similar. They'd likely react to the same minor noise. You wouldn't get that true structural perspective. You need the higher time frame to represent a genuinely different, more significant level of market activity.
Got it. So establish that proper higher time frame first. What else in the data zone configuration?
Next is the zone pivot look back. This setting basically controls how sensitive the indicator is when identifying the swing highs and lows that form the boundaries of the zones.
How does that work?
A lower number, maybe something like 5, makes it more sensitive. It will identify more swing points and therefore find more zones, but they might be smaller, more frequent zones. This could be good for, say, a scalper looking for lots of quick opportunities.
Okay. And a higher number.
A higher number like 15 or 20 makes it less sensitive. It filters out the minor wiggles and only identifies the more significant, visually obvious swing highs and lows. This means fewer zones, but the ones it finds are likely to be structurally stronger, more reliable, better suited for a swing trader perhaps. The default is usually around 10, which is a decent balance to start with.
All right, so you adjust that based on how selective you want the zone identification to be. What about the zone's thickness?
Ah, yes. That's controlled by the zone height average true range factor. This is pretty neat because it makes the zones dynamic. They adapt to how volatile the market is right now.
How does it use average true range, ATR?
ATR is a standard indicator that measures recent price volatility. The Supply and Demand Pro indicator uses the current ATR value to help determine how thick or tall the zone should be drawn. The factor setting is just a multiplier for that ATR value.
So if the market gets really choppy, the zones automatically get wider.
Exactly. If there's a big news event and volatility spikes, the ATR goes up and the zones expand to give price a bit more room to move without immediately invalidating the zone. Conversely, in quiet markets, the zones become thinner, more precise.
And you can adjust that factor.
Yes. If you set a higher factor, say 1.5, you'll get wider, more defensive zones. This might mean using a slightly wider stop loss, but it offers more protection against getting stopped out by minor spikes or whipsaws.
Sure.
If you set a lower factor, maybe 0.8, you get thinner, tighter zones. This allows for more precise entries and potentially tighter stop losses, but you're more vulnerable to quick volatility spikes. So it's a trade-off between safety and precision. You tune it to your preference.
Makes sense. Okay, let's move on from zone definition to those confirmation signals we talked about, the price action settings, liquidity sweeps, and engulfing candles.
Right. In the settings, you'll find simple toggles to turn the detection of these patterns on or off, both for your current time frame and, more importantly, for that selected higher time frame.
And you emphasized the higher time frame detection earlier.
Absolutely. Particularly the higher time frame candle liquidity sweep detection. Finding a clear stop hunt on a 4-hour or daily chart, that's a major event. It's often a sign of deliberate institutional positioning. So you definitely want that enabled, and you want the indicator scoring system to give that event significant weight.
And the higher time frame engulfing detection, similar importance.
Very important, yes. This setting looks for a strong engulfing candle, a classic reversal pattern that forms right within or immediately after exiting one of those key higher time frame zones.
So confluence again, structure plus price action.
Exactly. Imagine price pulls back to a solid 4-hour demand zone, and then the 4-hour candle closes as a massive bullish engulfing pattern. That's a very high conviction signal. It suggests the momentum shift is real, and it's happening at a structurally significant. Enabling this detection tells the probabilistic score to look for this powerful confirmation and boost the score accordingly when it occurs.
Okay, super clear. Now for the final piece of configuration, what you called the brain, the probabilistic reversal score configuration.
Yeah, this is where you get to customize the recipe for that final score. You'll see 4 slider bars, one for each of the pillars we discussed. Zone strength, oscillator, which covers the multi-time frame momentum, price action, and volume delta.
So you can decide how much importance to give each pillar.
Precisely. This is where you align the indicator's logic with your trading philosophy. Let's say you're heavily focused on order flow. You really trust what the tick data is showing you. You might crank up the volume delta weight slider significantly, maybe to 40 or 50%. You're telling the indicator, give extra importance to the real-time buying and selling pressure.
Okay. What if you're more of a classical chartist?
Then you might give more weight to zone strength, the quality and location of the zone, and price action, those engulfing candles and sweeps. Maybe you set both of those to 35 or 40% and give less weight to the oscillators and volume delta because your strategy relies more on clean structure and candlestick confirmations.
So you can really tailor it to what signals you trust most.
That's the goal. It adapts to your style and what you find most reliable. Then there are a couple of other key settings within the score configuration. One is the higher time frame zone strength multiplier.
What does that do?
It's basically a confidence booster when price enters a zone from your selected higher time frame. By default, it might be set to something like 1.2x. This just acknowledges that, say, a 4-hour demand zone is inherently more significant than a 15-minute demand zone. So when price enters that major structural zone, the overall probability score gets a slight amplification, reflecting the importance of that alignment.
Got it. A little extra weight for the big levels.
Exactly. And the last one here is the oscillator time frame weights. This lets you fine-tune the influence of the momentum readings from those 6 different time frames we talked about.
So you can prioritize certain time frames within the momentum calculation.
Yes, and we strongly recommend doing this. You should generally assign higher weights to the longer time frames, like the daily chart, time frame 6 in the settings, and progressively lower weights to the shorter time frames, like the 5-minute time frame 1.
Why is that important?
It forces the score to prioritize the bigger picture momentum. If the daily trend is strongly bullish, this weighting ensures that the score for a potential short trade setup, even if it looks okay on the 15-minute chart, will be significantly dampened. It helps prevent you from counter-trend trading against the dominant macro flow. You're telling the indicator, respect the main trend above all else.
That makes a lot of sense. Prioritizing the forest over the trees, essentially.
You got it. So those settings together, the component weights, the HTF multiplier, the oscillator weights, allow you to really calibrate the indicator's brain to think like you do.
Okay, we've covered the mechanics, the 4 pillars, and how to configure everything. Now, let's get practical. How do we actually use this indicator and that probability score to make trading decisions? Let's maybe look at it from 2 perspectives. Someone relatively new to trading versus a more seasoned pro.
Good idea. The approach can definitely differ. For the new trader, the primary goal should be using the indicator to build confidence and filter for only the highest quality setups. Simplicity and safety are key.
So how would they use the score?
They should probably treat that reversal probability score as their main filter. Configure the indicator conservatively, as we discussed, maybe focusing weights on zone strength and higher time frame momentum. Then set a fairly high threshold for alerts, say 70% or even 75% probability.
Okay, only looking for really strong signals.
Exactly. And critically, they might initially filter those alerts to only trigger when price is interacting with a higher time frame zone. Forget the minor time frame zones for now.
Focusing purely on the major structural turning point.
Right. They're essentially telling the system, only bother me when price hits a major level and all the analytical components, structure, momentum, price action, maybe even volume delta are strongly aligned, giving us a score above 75%. This approach drastically reduces the number of signals, filters out a lot of noise, and focuses them purely on A-plus setups. It helps remove that subjective doubt and hesitation because the data is screaming confirmation.
Okay, that sounds like a solid way to build consistency and avoid overtrading. What about the professional trader? How might their usage differ?
The experienced trader likely already has a well-defined strategy or edge. They're not necessarily looking for the indicator to give them trades, but rather to validate their own analysis and perhaps refine their entry or risk management.
So using it more as a confirmation tool.
Exactly. They might still use the overall sweater, perhaps with a slightly lower threshold if their strategy allows for more aggressive entries, but they'll likely lean more heavily on customizing the component weights to match their specific edge. For example, the order flow trader, maxing out volume delta weight. And they might set up more specific alerts. For instance, a pro might create an alert that only triggers when all of these conditions are met. Price is inside a higher time frame zone, and a higher time frame engulfing candle has just closed, and volume delta shows absorption. Even if the overall probability score is only, say, 65%, that specific confluence of events might be their high conviction entry signal according to their plan. They use the indicator's components to pinpoint their ideal setup with precision.
Got it. So the pro uses it for validation and tactical refinement, while the newbie uses it more as a primary filter and confidence builder.
That's a good way to put it.
Okay, let's make this even more concrete. Can you walk us through a hypothetical trade, step by step, using the indicator? Let's use that example bullish trade setup you mentioned.
Sure. Let's imagine we're watching the 30-minute chart for our entries, and we've set our indicator's higher time frame to the 4-hour chart.
Okay, 30-minute execution, 4-hour context.
Right. Step 1. Zone identification. The market's been selling off pretty hard, maybe for a few hours or even days. Price eventually drops into a significant 4-hour demand zone that the indicator has automatically drawn on our chart.
So, potential support level identified. Do we jump in? Not
yet. We're interested, but patience is crucial. We glance at the probabilistic reversal score. Initially, it's probably quite low, maybe only 40% or 45%. Why? Because the recent bearish momentum is still strong, the oscillators might still be pointing down hard, price action hasn't shown any reversal signs yet. The score is telling us conditions aren't ripe yet. Wait.
Okay, so the low score prevents a premature entry. We wait for conditions to improve.
Exactly. We watch price interact with the zone on the 30-minute chart. Maybe it chops around a bit. The score might slowly tick up. 48%, 52%, 60%. This shows the internal battle. The selling pressure is maybe starting to ease or some absorption is being detected.
Still waiting for that clear signal, though.
Right. Then, step 2. The signal threshold is crossed. Let's say we've set our minimum score threshold at 75%. Suddenly, we see the score jump decisively. Maybe it goes from 65% to 78% in 1 or 2 candles. An alert pops up on our screen.
What caused that jump?
It means enough of the underlying analytical components have now aligned. Perhaps the multi-time frame oscillators, across maybe 4 or 5 of the 6 time frames, have now reached deeply oversold levels. And maybe the volume delta analysis, pillar 4, has just detected a significant surge in buying absorption, indicating institutions are stepping in forcefully. The score crossing our threshold is the indicator saying, okay, the statistical ducks are starting to line up.
All right, the data is now supporting a potential reversal. Is that the entry signal?
Not quite yet. This is the critical moment. The score tells us the probability is high, the why is there, but we still need the when, the final trigger, the price action confirmation. So, step 3, wait for the entry trigger.
Looking for that specific candle pattern.
Exactly. We're watching the 30-minute candles form 4-hour zone, and then, bam, a candle closes. It's a large, strong, bullish, engulfing candle. It completely swamps the previous bearish candle, maybe even the previous two, and closes near its high. That's our definitive confirmation.
The final piece of the puzzle.
Yes. Now we have the confluence. 1, high probability score. The beta says conditions are ripe. 2, institutional structure. Price is in a key 4-hour zone. 3, active confirmation. A strong, bullish, engulfing candle just formed.
So now we act.
Now we act. Step 4, execution and risk management. We'd enter a buy order, maybe market or limit, right around the close of that engulfing candle. Where does the stop loss go? The indicator helps define this clearly. Logically, it goes just below the low point of that 4-hour demand zone. We respect the boundary defined by the institutional footprint.
Okay, defined entry, defined risk. What about the target?
The indicator often helps here too by automatically drawing the opposing zones. We'd look upwards on the chart for the nearest relevant supply zone, maybe a 30-minute or a 4-hour supply zone. That becomes our initial take profit target.
And the key benefit here is the risk to reward potential, right?
Absolutely. This is where it comes together. Because the indicator helps us find a precise entry point, the engulfing candle, and a tight logical stop loss just below the zone, our initial risk, the distance from entry to stop, is relatively small. But the potential reward, the distance from entry to the opposing supply zone, can be significantly larger.
So you're aiming for that asymmetric risk to reward.
That's the professional approach. We're looking for setups where our potential profit is maybe 2, 3, 4 times or even more than our potential loss. The indicator facilitates finding these high probability entries within well-defined zones, making those favorable risk-reward scenarios much easier to identify and execute consistently.
And this whole process, this trade example, it seems like it ties back to the traditional ways of judging supply and demand zone quality.
It does, absolutely. The score calculation implicitly incorporates those classic rules. Things like
Freshness.
Right, freshness. Generally, the fewer times a zone has been tested, the more likely it is that there are still significant unfilled institutional orders resting there. The indicator tracks this, sometimes referred to as exit count or similar, and tends to score fresher zones higher.
What else? The strength of departure.
Crucial. How did price leave the zone when it was originally formed? Was it a slow drift away, or was it an explosive, aggressive move with big, strong candles? That aggressive departure is seen as validation of a major imbalance, suggesting strong institutional force. The scoring system recognizes this and gives more weight to zones formed by powerful moves.
Okay. And the last one was time spent at the zone.
Yeah, this one's a bit counterintuitive. Generally, the less time price spent consolidating within the zone when it was created, the stronger the zone is considered.
Why is that?
Because long consolidation suggests a period of balance, of negotiation between buyers and sellers. But a very quick pivot, a sharp V reversal out of the zone, implies one side completely overwhelmed the other very quickly, a sign of a more significant imbalance. The indicator factors in this efficiency of the turn when assessing zone strength.
Got it. So the score isn't just random. It's encoding these established principles of S&D analysis.
That's the intention, yes, to quantify those qualitative rules. #tag 5. Advanced S&D strategies supported by Confluence.
All right, we've covered the basics in a solid entry model. Let's level up a bit and talk about more advanced strategies where this indicator can really shine, especially in finding that confluence you keep mentioning.
Definitely. The highest probability trades, the ones professionals really hunt for, rarely rely on just one signal. They wait for multiple, ideally non-correlated factors to align, and this indicator, with its different pillars, basically acts as a real-time confluence checklist.
Makes sense. So what's an example of an advanced strategy it supports?
Let's focus first on leveraging those liquidity sweeps or stop hunts we discussed. We know these are often deliberate institutional maneuvers.
Right, pushing price to grab orders before the real move.
Exactly. Now, the indicator is great here because, as we said, it can automatically detect and mark these sweeps on your chart, both on your current time frame and, more importantly, on the higher time frame. Seeing that higher time frame liquidity sweep alert pop up is a big deal.
Okay, so the indicator flags the event. How do we trade it?
One powerful strategy is called the liquidity sweep and reclaim. Imagine price makes a sharp move below a well-defined swing low on the chart. The indicator marks it. Liquidity sweep detected. This triggers all the sell stops sitting below that low. The crucial part is the reclaim. Price doesn't stay down there. It quickly and aggressively reverses, closing a strong candle back above the level it just broke. That immediate, violent rejection signals that the sweep was likely manipulative, designed to gather liquidity, and the institutions are now driving price the other way.
And that reversal itself creates a new zone, right?
Precisely. That whole sweep and reclaim action often carves out a brand new, very high-quality demand zone right there, born directly from that institutional action. It's a zone created by force.
So do you jump in on that immediate reversal candle?
You can, but it's often very volatile, and the risk can be harder to define. The more refined strategy is to wait for the first pullback into that newly created demand zone. Let price come back and test the area where the manipulation occurred.
Ah, okay. Wait for the retest.
Yes. And as price pulls back into that new zone, you look for confirmation. That could be the probabilistic reversal score spiking above your threshold, maybe 75% or 80% in this high conviction scenario. Or you might look for a confirmation pattern on a lower time frame, like a bullish engulfing candle forming right within that sweep-induced zone.
So you're essentially waiting for the institutions to show their hand with the sweep, then joining them on the first sign of confirmation as they defend that level.
That's the idea. Trading with the force revealed by the liquidity hunt, not getting caught by it.
Very cool strategy. What's another advanced application?
Another critical one is using the indicator to ensure proper market structure context, specifically understanding premium versus discount pricing. This is fundamental S&D theory.
Explain that concept again briefly.
Sure. You identify the current relevant trading range, find the most recent significant swing high and swing low. Draw a line exactly halfway between them. That's your 50% equilibrium point.
Okay, the middle of the range.
Right. Any price action happening above that 50% level is considered the premium part of the range, essentially. Prices are relatively expensive here. Any price action below the 50% level is the discount part of the range. Prices are relatively cheap.
Got it. Premium expensive, discount cheap.
Yeah.
How does this apply to zones?
The core rule, a very important one, is you should generally only be looking to sell from supply zones when price is already in the premium expensive area. And conversely, you should only be looking to buy from demand zones when price is already in the discount cheap area.
So don't buy high and don't sell low, basically, within the context of the current range.
Exactly. It prevents you from chasing moves that are already extended and likely to reverse. How does the indicator help? Well, that multi-time frame table, Pillar 3, gives you an instant read on the broader momentum and trend bias across those 6 timeframes.
Ah, so you can cross-reference.
Yes. Let's say you see price approaching a nice-looking demand zone on your 15-minute chart. Before taking the trade, you glance at the multi-time frame table. If it shows strong bearish pressure across the higher timeframes, indicating you might still be in a premium area overall or the downtrend is dominant, you might hesitate or skip the trade, even if the local zone looks good. But if the table shows bullishness on higher timeframes, suggesting you're likely in a discount area and the macro trend supports longs, that adds significant confidence to your demand zone trade. It helps align your entry with the structurally appropriate price context.
Okay, using the momentum table for that premium discount context check. Smart. What about a third strategy?
Let's talk about the break and retest flip, or what's often called a supply-demand flip zone. This is more of a continuation pattern strategy.
How does that work?
It starts when a previously respected zone fails. Imagine a clear demand zone that has held price up multiple times. Then suddenly, price slices right through it with strong bearish momentum, closing decisively below the zone.
Okay, the support breaks.
Right. That break signifies a shift in control. The buyers who were defending that level have been overwhelmed. The institutional sentiment has likely flipped bearish. Now, that broken demand zone often reverses its role. It becomes new resistance or effectively a new supply zone.
The old floor becomes the new ceiling.
Exactly. The indicator can help here by potentially flagging the break of structure, BOS, when that decisive close below the zone occurs, confirming the zone has failed. The trading strategy is then to wait for price to pull back and retest that broken level, the newly formed supply, flip zone.
Wait for the retest again. Seems like a common theme.
Patience pays in trading. As price comes back up to touch the underside of that failed demand zone, you watch for signs of rejection. This is where the indicator comes back in. You'd look for the probabilistic reversal score to increase significantly at that flip level, suggesting that the momentum, oscillators turning down, price action, maybe a bearish engulfing, and potentially volume delta are all confirming that sellers are now defending this new resistance.
So the score validates that the flip is holding.
Yes. If you get that high score confirmation on the retest of the broken zone, you'd look to enter a short position, trading in alignment with the newly established bearish momentum, using the flip zone to define your risk.
Great stuff. 3 solid advanced strategies leveraging confluence and specific indicator features. Before we wrap up, we absolutely have to touch on risk management again.
Non-negotiable. Doesn't matter how good the indicator or the strategy is if you blow up your account on one bad trade. The foundation of professional trading is risk management integration.
And the core principle there is
Fixed fractional position sizing. Always. This means you decide beforehand what percentage of your trading capital you are willing to risk on any single trade. Typically 1%, maybe 2% at the absolute maximum for aggressive traders, but 1% is standard.
And you risk that same percentage on every trade, regardless of how confident you feel.
Every single time. Whether the probability score is 70% or 90%, your risk in dollar terms, or whatever your account currency is, should be calculated based on that fixed 1%, or your chosen percentage, of your current account balance. Why? Because it enforces discipline and ensures that a string of losses, which will happen to every trader, doesn't wipe you out.
And how does the Supply and Demand Pro indicator specifically help with implementing this?
It helps immensely because, as we've discussed, it's designed to identify precise entry points, like the close of a confirmation candle, within well-defined structural zones. This allows for the placement of tight, logical stop losses just outside the zone boundary.
Right, minimizing the R and the RR ratio.
Exactly. By providing these clear zones and confirmation signals, the indicator facilitates finding trades with that asymmetric risk-to-reward profile we talked about. If your stop loss is tight because the zone is well-defined, it becomes much easier to target profits that are 3, 4, 5 times or more than your initial risk.
And that mathematical edge is key.
It's everything long-term. If you can consistently find trades where your potential reward is, say, 3 times your risk, a 1.3 RR, you only need to be right a little over 25% of the time to break even. Be right 30-40% of the time, and you're building significant profit. The indicator provides the framework to find those high probability entries with defined risk, making that professional mindset much more achievable in practice. #tag6. Conclusion and final thought.
Okay, this has been incredibly insightful. We've really gone deep into how this tool works. What we've essentially outlined today is a shift, isn't it? Moving away from trading based on gut feelings, fear, or just guesswork.
Yeah, moving away from that subjective approach towards something much more structured, more rule-based, and importantly, data-driven.
And the Supply and Demand Pro indicator seems to achieve that by bringing together those 4 distinct analytical angles: the institutional zones, the multi-time frame momentum view, the key price action signals, and that deep dive into order flow with volume delta.
Right. It takes all those potentially complex and sometimes conflicting pieces of information and synthesizes them, boils them down into that one clear objective measure, the probabilistic reversal score.
So for you listening, the real takeaway here, the core benefit, seems to be about building consistency. It's about having a process you can rely on, trade after trade.
Absolutely. And perhaps just as importantly, it's about trading with confidence. Real objective confidence, grounded in data, not just hope. When the market is chaotic and pressure is high, having that score, that analytical rigor backing your decision, that can make all the difference in actually pulling the trigger or staying out when you should.
It's not a crystal ball, obviously.
No, definitely not. It's an analytical assistant. It provides a statistically derived probability, the why things might happen, and helps pinpoint the when with confirmation signals. But risk management and discipline are still entirely on you.
Makes sense. So let's leave our listeners with something to chew on, a final thought.
Okay, here's something to consider. If this tool, by combining 4 different non-correlated ways of looking at the market, can give you a calculated statistical probability of a reversal happening right now, what percentage of trades are you still willing to take based purely on your intuition or maybe fear of missing out that go directly against that calculated probability?
That's a tough question.
Think about it. How many times has hesitation cost you because you weren't sure? Or how many times have you jumped in too early based on a feeling? What's the value of having an objective, quantified confidence score right there on your chart telling you the odds based on the data? How might that change your decision-making at those critical moments?
That really highlights the potential power of bringing objective data into what can feel like a very subjective process. A lot to think about there. Well, thank you for walking us through all of that today. This deep dive into the Supply and Demand Pro indicator has been incredibly comprehensive. Hopefully for everyone listening, this gives you a clear understanding and a potential game plan for using data to trade with more confidence, maybe find a more consistent edge. Thanks for joining us on the deep dive. We'll catch you next time.